traders, it is Sunday, January 12th, and the theme of today's video is going to be Don't Do It! But before I get to that, like I do in every single video, I want to take a look at our previous picks. So we had AFRM. That was a pick that I highlighted on Wednesday during our live event. By the way, if you haven't attended our live events, please do. They are on Wednesdays. We start them at 12 o'clock noon Eastern time, and we answer all of your questions. The same questions you have are probably asked by other traders. That was a beautiful pick, and you can see right in here, AFRM. Actually, we had a holiday this week, or at least the market was closed on Thursday in memory of President Carter. So let's zoom out and take a look at what the price action was the previous day when the live event took place. It was right in here, Friday. Whoosh, beautiful. That was a nice 10% move in about a day and a half. Really solid pick. I still like AFRM on the downside. I think it's going to continue to go down. Probably will challenge that 100-day moving average, so I hope you're in that trade. CVNA, that is a short that I gave you a week ago. And you can see that trade came out right here. That was the price action on the previous Friday. Loved the short there. Loved that heavy volume. Oh, but wait a minute, Pete. This stock is trading higher. What a crappy pick. Well, yes, if we're just going to take a look at the price action this week, not what I wanted to see, but I still love the short. In fact, I like it even a little bit better, and I would be looking to add to it. So, why? What happened? Well, this week we got a bullish recommendation, a buy rating from a couple of banks and a brokerage analyst. So as far as these analysts are concerned, they're typically a day late and a dollar short as far as I'm concerned. And many of them are looking out, let's say, a year or two or three from now. I'm looking right here, right now. What do I see? I see a very bearish chart with a stock that is starting to break down through major support levels. So when you get these brokerage upgrades, you have to weather the storm. Okay, if you're on the wrong side of the trade, don't panic. The price action here tells me that this stock is in trouble. So we get this tiny little bounce, and now that little buying has run its course. I'm expecting CVNA to continue to move lower. And you can see how resistance was confirmed at the 100-day moving average. So the stock has that initial run up, and then the selling pressure resumes. I think this stock has got a clean path down to the 200-day moving average. So I like it on a swing basis. I also think that once this buying starts to dry up, wham, 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 the sellers are going to be back, and they're going to drive the stock down, hover over the E. Earnings on February 27th, so lots of time to ride this trade out. I did also highlight LUNR as a long in last Sunday's video, but with conditions. Again, we had lots of choppy price action in the market. It was heading lower. We had a bullish and a bearish pick, but it was all pending on the type of market action that we were going to see. And I told you back in here a week ago, please go check the videos. That's why I start every one of these off with a review of my previous pick. And here you can see LUNR with this nice long green candle the Friday before the Sunday video. And then we open here on Monday. So let's take a look at that M5 price action. And I had mentioned to you that this stock has a tendency to dip. Look at how choppy this stock is. Okay, it's all over the board. So we get that nice little rally and get that nice little rally there. And this is what we were looking to do a week ago. We wanted to buy dips on this particular stock. And let's see, that would have been on the 5th. So let me go back into that chart. So here is where we wanted to buy, down in here and down in here. And I set price alerts here and here in that video. So if I can buy the stock at that price, I want in. Well, we got the open on Monday, never triggered. Okay, so come in on Tuesday, ding, 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 we get a price alert. Then we get the other price alert. Hey, great. Maybe this is the time to buy LUNR. No. Well, look at that stock sell off. Gee, Pete, another crappy pick from you. What's going on? Well, duh. Everything we do is based on the market. And so if we go out to a 15-minute chart, we can see that on Tuesday, this is what the market was doing when those alerts were triggered. Selling off hard. Well, you're not going to want to buy any stock when you've got that type of market weakness. And we were looking for some very short-term opportunities to buy a strong stock on a dip, but we needed to have that market strength. That's what I told you last week. So you didn't have it. So there's no reason to take a position in LUNR. So right now, I love AFRM. I'm liking CVNA, but I need to see continued weakness, and I would love to see a day when the market is higher and the stock is lower. So that tells me that even with a nice bounce in the market, and we might get a bounce Monday or Tuesday this week, even with a nice bounce in the market, there's still selling pressure on CVNA. And that will be my sign that I can add to that short position because it's going to be going lower. So you can see it had a nice, decent little drop. On Friday, it was able to find support. So that's what I'll be watching. Let's take a look at the market. What in the heck happened on Friday? This is one of the don't do it's from the thumbnail. What you don't want to do is you don't want to trade what you think. So if you came in Friday and you looked at the jobs report and you went, holy cow, this is a great number. 255,000 new jobs? Oh, and the market's pulling back, but it's got to rally. That's a great jobs number. People are employed. That's a good thing, right? Well, the market might have dipped a little bit because of the wage component. No, the market didn't dip because of the wage component. It came in at 0.3%. That's also fairly low. And we know the wages component is the largest input cost for manufacturers. So that is inflationary when hourly wages start to go up. And we know that the Fed is concerned about inflation. 0.3% is actually a decent level. So you get a strong employment report, you get a fairly low hourly wages component, and the market drops. If you came in and you bought that open on Friday, you got your butt handed to you, and then you'd be yelling at your computer screen like the thumbnail. Don't do it. So what has the market been telling us recently? I've been going through the technical analysis over the course of the last month or so. In fact, back in December, we took gains on all of our bullish swing trades. Why? Because this price action here was telling me that a dip was coming. Not this price action here, not this price action here, the price action here leading up to the top is what we have to focus on as traders. That long-term price action tells us what's coming ahead. And when we start to see more frequent dips, the dips last longer, and they're deeper than the previous dips, that's a warning sign. When the volume is light, that's a warning sign. When we start making marginal new highs instead of explosive new highs, that's a warning sign. It tells us that buyers are not that interested. When we don't get a year-end rally, that's a warning sign. That would typically be a very bullish time of year, and we didn't get it this year. We also had some measured moves that were coming into play that put us right above that high in December. So from just an odds standpoint, very, very tiny, limited upside, pretty dang big downside potential. So now we can look back in the rearview mirror and go, oh yeah, that was fantastic. Boy, that was a good call. How did you know to get out there? Because of the price action that preceded it. Super, super important, okay? You're going to hear people looking at individual candles, bullish hammer, bearish engulfing candle, and they're going to point to that. That candle is meaningless without all the price action that came before it, because the table is being set for that candle and for that opportunity, and then when you get it, you're all over it. That's how it works. Okay, so it's not the candle, it's what came before it. And what do we see happening right now? What happened on Friday? Oh my God, where did that number come from? And I published an article. I was short into the jobs report. Why? How the heck did I know? I had somebody else ask me, hey, huge move down on the jobs number. Did you take your gains? I said, no, I didn't take gains on that position. Why not? So because I felt that the odds of testing the 100-day moving average were much, much higher than the odds of testing the 50-day moving average. Why? Well, let's get into some of the analysis right now. And again, please go back and watch my previous videos because they set the context for what's happening right now. Just like what I'm discussing today is going to set up my future videos. That's how trading works. It's a time continuum. So what had me alerted that we could see a drop? Well, even into this FOMC statement right in here, I was feeling pretty dang bearish, and I thought that this was going to have a chance to crack down. So I did short right after the FOMC statement because we had two very long consecutive red candles closing on their low. That tells me that institutions are aggressive. Institutions are looking to reduce risk. And just looking at the price action, what you'd like to see, and the way that you're always trying to gauge who has the upper hand here. Do buyers have the upper hand, or do sellers have the upper hand? And to what degree? To what degree is also a very important component. And the tell to what degree is the volume. When you don't have a lot of volume, there's not a lot of conviction by either side. So it doesn't mean go long or go short or fade the move. It just tells you that that move that's currently happening just doesn't have any real teeth to it. So we want to see those big moves, and we want to see them on heavy volume. So when you get a dip like this, dip here, dip here, dip here, dip here, dip here, we want to see this heavy volume bounce. And I've used this analogy before. We want the market to be jabbed in the butt like a cow with a cattle prod. Okay? Boom! Yo! That is a hell of a reaction. Boom off of that 50-day moving average. Yow! All right, that shows me some excitement. When I have excitement and I have institutional involvement, I have volume. They want in. This is a good buying opportunity. They see it as such. This is a good buying opportunity. Did we dip long? Nope. Did we dip very deep? Nope. Barely even touched the 100-day moving average. And yow! It screams higher on volume. That's how you gauge interest. What's happened recently? Got this dip here. Yow. No, we didn't even jump off the 50-day moving average. We kind of tried to inch a little bit higher, and then blam, here come the sellers again. Notice how much time we are spending below the 50-day moving average. Market's very comfortable there. It wasn't comfortable there a month ago, 2 months ago, 6 months ago. Heck no, look at what happened every time we had a dip. We aren't getting that now. What does that tell us about buyers and sellers? It tells us that buyers aren't as interested and that sellers are more persistent. That could signal that there is a trend change coming. We could see a reversal in here, or we could just see a normal pullback in a bull market. We don't know which one we're going to get right now. So what I'm envisioning right now, based on the price action, and mind you, kind of here's what's in play. When you go in and take a look at the monthly chart, okay, that's a pretty strong trend, dating back to 8 years ago. Yeah, okay, I want to be a part of that trend. So the market's always trending higher, but you can see that it does have transitionary periods where it goes into times of weakness. Bull markets die hard, okay, because the market has gone up for 100 years, literally. Strong uptrend. So when you have these moments of weakness, the market's not just going to fall apart. It's not going to do that. But in the initial stages, it's going to have these dips and bounces, and dips and bounces, and dips and bounces. I encourage you to go back and take a look at the price action from 2022. Okay, the very beginning. This is when the Fed started to hike interest rates. I'm not going to zoom back there. You can do it on your own. Look at that initial price action. Very stubborn on the way down. Lots of bounces. And we're going to see that too as the market's transitioning. Here's the pattern that I'm looking for. If you draw this line visually, you'll see kind of a downward sloping channel, and you can draw a line across the tops. So that line there lines up pretty well with this line here. And how did I draw them? Well, I'm going to focus on the downward sloping trend line on the high first, connecting the highs. We call that a high minus, H minus. That's what I'm going to be focusing on. And then I'll be looking for something that's parallel to it that kind of lines up with what we have on the D1 bars here. And all that does is it gives me a visual, okay? It's just simply an aid. And it tells me that the process of rolling over here is going to be choppy. So we're going to have some bounces, then we're going to have some sell-offs, then we're going to have some bounces, then we're going to have some sell-offs. All along the way, what we will see is a series of lower highs and lower lows. And that would be very typical of a market that's starting to transition and to get more bearish. Ultimately, I think we've got a chance to test the 200-day moving average. But it's not going to be easy because you're going to get a nice big move like this Oh, I'm going to get short. I'm going to get short. Oh, goody, goody, goody. The market's going to fall apart here. And then, doink, you're going to get this big rally and you're going to go, oh, this sucks. It's going to go back up. So I'll buy here. So you buy here and then the market has another leg lower and you're like, crap. That didn't work either. Maybe it is going to be a short. Okay, so I'll short here. And then, doink, you get another bounce. You're a day late and $1 short. Don't do it. What you want to do, and the mindset that you want to be in, is that this is going to be a gradual trend lower, and that when you get these peaks in here, this is where you're interested in shorting. Okay? Not down here, up here. That's where you want to short. You get your move lower, take some gains. Wait for the next bounce. Get short up here, wait for the next drop. Get these nice long red candles, take your gains. Market bounces, look for an opportunity to short. What I would not advise you to do is to get cute and to try and play these little bounces from the long side, okay? They're not lasting that long, and you can see that the selling pressure is starting to build. At any time, the second shoe could drop and we could get that nice long red candle. So you want to be in a mindset of shorting bounces and taking gains on those nice big drops into weakness. So that's how I would be playing it. And what has me so concerned? Well, it's the technicals. That's all you have to watch, is what are the technicals telling you. You don't need to do a lot of fundamental analysis, but I can tell you that the fundamental picture does not look good. I've gone through this in the last few videos, so I don't want to spend a lot of time on it. Pete, what are some of the biggest factors that you see that determine if a trader is going to be good or bad? Well, almost at the top of the list is awareness. Discipline, patience, very, very important also. But awareness, what in the hell is going on around you? What is happening? And so it's awareness on a technical basis. It is an awareness on a fundamental basis. You need to be aware of what the news is. And one of the pieces of information that I think a lot of people might have missed Friday morning was that even in light of a good jobs report, there was a jobs report that came out Thursday. It's by a private company called Challenger, Gray and Christmas. So what do you think would come before a decline in employment? Could it be that companies don't plan to hire as many people in the future? Yes, absolutely. I mean, it's kind of obvious, isn't it? So if you're a business and you're kind of seeing some tough times ahead and the new orders aren't flowing in, I'm not going to be hiring as many people. I don't need them, thank you. I've got plenty of people on staff right now. And that's what Challenger, Gray, and Christmas reported. And these companies also reported that they can see more and more job layoffs coming. In fact, they could see those coming fairly soon. And now that is going to be the precursor for a weak jobs report. So Thursday, when the market reopened, the futures reopened Thursday after our day of observance for Jimmy Carter, Challenger, Gray, and Christmas posted this report. These levels are the worst that we've seen, I believe, in about 8 years, and the prior level before that was in 2009, I believe. So yeah, conditions are deteriorating quickly. What did the futures do? As soon as they opened on Thursday, they sold off. They sold off on that number. Okay? Big tell. That told me that the focus, no matter how the jobs report came out Friday morning, Institutions were going to be looking at the challenger number, and they were going to be saying, hey, no matter how this number comes out, the reaction on Friday is going to be weak because others are going to be selling. So that futures drop is what I paid attention to, and that report is what I paid attention to. And yes, I shorted futures on Thursday, and I did cover them on Friday, and I'm going to go over why and how I traded that in just a second here. The price action, the technicals were also telling me that sellers are engaged. Okay, they are not being passive in here. They are knocking the market down. And there was another big tell right in here. See this little doji here? Oh, doji signal, blah, blah, blah. I don't care about any of that crap, quite honestly, because I'm watching the price action and I'm trying to see if sellers are aggressive or not. Well, what happened on this day last week? Well, we had Foxconn, a large semiconductor manufacturer, come out and say, hey, revenues were up 15% last quarter. Things are looking really good. So the entire tech sector bounces. They had this nice, big, beautiful move. And I thought, okay, well, this is kind of what I want. This is the litmus test I've been waiting for. And so we get this nice big rally. Oh, here we go. We're above the 50-day moving average. Go, go, go. We got all the semis driving the market higher. This is going to be a bullish flag on a D1 chart, and we're going to be off to the races, and we're going to take out the all-time high. Yeehaw! No. The selling pressure that I had seen earlier in the year and last year, we have this mixed overlapping candles, light volume little rally, and then we start rolling over and oh my God, look at the selling pressure come in. And we easily take out the low of the day. Easily take out the low of the day and whoosh, we keep drifting lower. Good news results in selling like this off of the high. That doesn't make sense. That tells me that sellers are out there. So we get this beautiful gap up on Wednesday. Oh man, does this get me salivating when I see this. I shorted this. Heck yeah, I shorted the heck out of that. Wham! Right out of the open, you already saw selling pressure. Could they, if this was a fluke, which it wasn't, this late day selling the day before, get this bounce up, oh, this is overdone. Okay, well, if it is, then what I would expect to see is long green candle, long green candle, long green candle. Hey, they like it. The buyers are back in there. They're going to drive this thing above the 50-day moving average. But I suspected that would not happen. I was watching for a gap reversal, and these two candles told me, yep, they're going to sell this thing. And then as soon as we took out that low, I was adding in here, yep, get that nice drop right in there. Now, I didn't catch this late move right in here. I thought we were going to bounce, 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 get a long red candle, and then reverse right back up, that support would hold. But it did leak lower, and that was another sign of weakness. So let's talk about the price action on Friday. Getting into a little bit of day trading on futures here, but it's okay because I know some of you day trade futures. When you get a gap down like this, you're always fearful on gap and goes because you have the risk of a gap reversal. And this move right here and a reversal would be deadly because there's a lot of distance, I think about 40 points from here to here. Well, you could take a world of hurt if you get this bounce. But the price action leading into this day was the clue, okay? It wasn't this gap down. The clue was this. All right, that table was set. This was the clue. So you get the gap down, and now you're watching, if you hadn't shorted overnight, for any kind of bounce into this gap, because that would have attracted buyers. And hey, we've tested this low before, and now all of a sudden out of nowhere, buyers are interested. Got good news earlier in the week, they sold it. But now for whatever reason, they're going to buy this? No, especially not with that challenger number. So this is a pretty easy short if you knew the backdrop and you knew everything that was going on. When you get big, steep, swift moves like that, I took my gains down here, and I'll show you why. Technically, one of the reasons is because we had this big, swift move lower. And when you get steep, steep moves like this, you're going to get big bounces. That was a big bounce. Okay, we had another test of the low right here. Nice. That selling pressure is legitimate. This set up a really nice short. You have another nice big bounce. Okay, when this runs its course, this move is legitimate. It's just overextended. Okay, so that's how you have to look at it. You're going to get days when you get this drip, 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 drip lower, and it's just steady all day. Okay, those are moves that you can short on, add, all the while this VWAP is being checked. Okay, great example here. So you get the initial drop. This is a gap reversal. Okay, you can take gains here because this is a substantial drop. Get a couple of long stack candles and then can't get through that level. Okay, I'm going to reinitiate some short positions here, and I'm going to be looking for opportunities to add. Okay, this is all constructive price action, and we get this nice little bounce. I'm going to add here. Take out the low, I can add here. So this is nice, consistent downward price action, and you can add along the way. When you get this super swift drop, you got to expect these bounces, and then you just look for opportunities to continue to short. Now, the other thing that came into play on Friday was we had the 100-day moving average right there. So you get this big initial whoosh down. Well, given that the market always goes up, and given that bull markets die hard, buyers are going to be coming in, especially in the initial stages of the market rolling over, and they're going to buy. They're going to buy dips. They've been conditioned to buy dips forever and ever, and they'll try and do that until they are discouraged. And the way that they get discouraged is when they try and buy 3 or 4 or 5 dips and they keep getting it rammed down their throat, then they stop doing it, and that's when the market starts to accelerate on the downside. So hopefully that gives you some information on the price action that you would need to be looking at for day trading S&P. Nice, steady, slow drift lower. Use VWAP as a guide and short when the market can't get back up through it. But if you get these big sharp moves lower, take gains, look to reload. Take gains, look to reload. Take gains. All right, so what are we going to do stock-wise here? What do I like? Well, I think first of all, we need to be cognizant of this downward sloping channel. Monday, what is tomorrow going to look like? I can tell you almost for sure what tomorrow is going to do. It's going to be a fairly dead, quiet day. How can I be so sure? Friday, we saw massive selling, okay? By the way, the Chinese market is not open yet, but I will be looking at it tonight, and if I do see selling in China, I might decide to short some futures overnight, and then we could crack down this 100-day moving average. I'm not really expecting that though. After every big drop, after every big red candle like this, what do you see? A day of rest. And the same is true on the upside. You get a really big, long green candle like this one. What do you get the next day? A day of rest. You look at every single long candle, day of rest, day of rest, day of rest, day of rest. How do I know it? I look at the daily chart. I look to see how many times have we had a big sell-off followed by another big sell-off. Hardly ever. How often do I get a big move in either direction followed by a day of rest? Almost all the time. So we do have a couple of driving forces this week that we need to be aware of. And you should always be looking ahead on the calendar. What kind of scheduled news releases do we have? Well, this week we've got very little on the economic side. We have CPI and PPI. They've been important in the past. They've been coming in. So chances are they're not going to produce a big move. Could they surprise the market? If they do, it's going to be the numbers are hotter than we would like. Inflation is higher than we would like. The Fed is not going to cut rates as aggressively as they had told us previously. So that would be bearish, okay? I don't think the numbers are going to make the market move really one way or the other. I think they're going to be fairly benign. So, and that's just based on how the numbers have come out recently. If you take a look at TLT, which is the US 10-year bond, you can see a steady decline, and this is a major breakdown. And that means that interest rates are relatively high and they're going higher. How can that be? The Fed is cutting interest rates. How can yields be going higher? Doesn't make sense. There's another reason for us to take gains up in here. I was seeing this disconnect. Didn't make sense to me. So higher yields is not good because I am seeing consumer default rates rise. They're not at an alarming level, but it's the trend. They're at 3%. Anything around 4% starts to get problematic. You know, and we're going to take a look at China in just a second here. China is in deep doo-doo. And this was kind of interesting because I did a video 2 weeks ago, I believe it was, or maybe it was even my year-end forecast. And I started to talk about the woes in China. And one of the comments that I got in the video was, Pete, you're so hard on China. I think you're wrong. Oh, okay. Well, I always pay attention to what other people have to say. If their observations are different from what I'm hearing, I'm interested. I always do research. And I love boots on the ground research, by the way. If somebody's actually there and I have a lot of that information, then I'm going to take it in. I trust what people have to say a lot more than what I read. And so I thought, okay, well, out of respect, I'll listen to this person. And they said, I just recently visited China. Everything was busy. The train stations were super busy. I got this feeling of real, vibrance. And, I've read similar from other people who have recently been to China. And so they posted a podcast or a link to a podcast video that was going to refute what I had to say. So I thought, okay, well, I'll take a look at it. It was Chinese propaganda. I couldn't believe it. Little old me with my tiny little YouTube channel, they came in and they posted this link. Well, how do I know it was them? They got people looking and monitoring stuff all over the place. I watched the video. I'm watching this video of this guy touring China, and he slept in an abandoned wind turbine factory. The whole video showed depression and economic decline. They didn't think I'd watch the video. So they put the link up there and said, oh, this has had 3 million views. You can see, China's doing great. Be very careful of your sources of information. Go in and check them. I was quite surprised by it, to be frank, because I'm nobody. I got a tiny little following here. They're always looking, apparently. I took it down from my video. I thought, yeah, I don't need this up there because I went back and forth. But man, I know that was definitely somebody from the Chinese government doing searches on YouTube that happened across my channel and posted that. What a bunch of bullshit. Wow. So let's take a look at FXI, and then I'm going to give you another don't do it. And this is a really big one. You can see this was the jump in FXI. This is an index of the 25 largest companies in China. They had a massive stimulus program to the tune of $1.3 trillion, and that was going to get consumers back on track. I knew from the second that I saw this is just complete fluff, because I've done my research on everything else that had been going on in China. And this is not going to resurrect consumer behavior. No, the consumers are pulling back in a massive, massive way. And they've got deflation going on. Deflation is a very slippery slope because consumers are cutting back on all of their spending. And you know that because you've watched my videos for the last few months. You know I've been hard on China, and I'm going to continue to be hard on China. I'm not hard on the Chinese people. I don't like what I see in their market. I believe that they are on the precipice of a credit crisis, and that concerns the hell out of me because credit markets are intertwined globally. And if you take out the second largest economy of the world, and where once it was fueling growth everywhere, it was the growth engine, you take that out of the equation, who's going to replace it? I don't see anyone. And so FXI has continued to break below this 100-day moving average, and you can see the selling pressure. So here's the don't do it. I will provide a link in my YouTube video today because this is very important. A lot of you have invested in Baidu, Alibaba. Don't do it. They are called VIEs, Variable Interest Entity. This is a farce. It's a shell corp. It is nothing. There's no substance to it. And I can't believe, I'll probably get in trouble with the SEC, and you know, the regulators are always watching people who aren't registered, but I can't believe that they let this happen. I can't believe that they're letting people invest like this, okay? They can, at any time, China can just remove these listings and the stock is worth zero because it's just a shell corporation. You don't own Alibaba. You're not a shareholder in the company. This is a shell corporation that oftentimes these entities are structured in the Bahamas or the Cayman Islands. There's nothing to it, okay? This is a really bad situation if you own these stocks for no other reason than just that they are worthless. Get rid of them, okay? Because unless you really trust China, I certainly don't. I'm going to post that link. This is some scary stuff. There's some investors who are going to get burned by this. There's so much for the SEC looking out for the investor, okay? Why did they do it? These companies don't even have to adhere to our regulatory reporting procedures. None of the rules and regulations apply. They were so excited to give American investors access to China's market that they threw all the other rules out the window that apply to everyone else, just so that they could gain access to those markets. Well, when their market is doing fine, and when those companies are doing fine, and they're all going up, great, no problem. But when everything starts, when the shit hits the fan, anything can happen. And so they can just simply yank these listings. China can yank these listings, whoosh, gone. You're left holding the bag. This is some scary stuff. Kyle Bass has also been very vocal about this. I'm going to post that link. So I like shorting, but I don't like that risk because even if I'm short, I don't know what would happen if China decided to just delist the stock. Are my puts worthless? If I shorted the stock, is everything just wiped out like it was never even there? I don't know how this gets settled. So I'm not going to do that. I'm going to go with a pick this week that's actually appeared on one of my searches. And I'm just looking for a bearish SMA cross. So one of the many searches that I have in Option Stalker Pro, we've got so many damn good searches, to be quite honest with you. It's so easy to find a good stock. I love it. We've got our trade signal, so all I have to do is look at red dots across the board on a M5 to D1 basis, and I'm going to go down to LVS. You can see on every time frame, except for a daily time frame, which is going to roll over soon, we've got red dots. Relative strength across every trend, across every timeline, red dots. Remember that time continuum I told you about? So on a 5-minute, 15-minute, 30-minute, 1 hour, daily basis, sell, 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 sell. Sell signals in agreement across every time frame. That's the time continuum on heavy volume. Looking pretty good. So let's go in and take a look at your pick of the week. Las Vegas Sands is a legitimate listing, okay? That's a U.S. company, and they are very dependent upon Macau gaming revenues. Almost all their revenues are tied to Singapore and Macau, which incidentally, Singapore is heavily dependent on economic activity in China. So casinos. Right now we've got revenue growth at those casinos. Yes, they've been up year over year, but that's because China was in a complete shutdown. Complete shutdown. And so now that 23% increase might look good on the surface, but if you compare that to where the revenues are versus 2019 pre-COVID, revenues are still at about 75% of where they were pre-COVID. So much for growth. We are well through COVID. We are way past COVID. Those numbers should be clipping along. Man, the Chinese are back. They are spending money. They are gambling. It is good times. No, it's not happening. That stimulus program hasn't even done anything to get those gaming revenues back. So let's take a look at LVS and let's overlay FXI to see if there's a correlation. Ah, looky there. FXI down, the gray line. Oh, this is nice. Look at that spike. Oh, yeah. Look at that. Now you can see how FXI has been sliding and LVS is starting to gradually roll over, and then doink. Last week, yeah, we started to see a pretty good little crackdown. Hover over the E. Always know when your earnings are coming out. January 22nd earnings. So we've got about 10 days to ride this short. We never hold over the earnings announcement, ever. That is a binary event, and we can hit 75-80% win rates. Why would I go into a 50-50 proposition? There's no reason for it. No matter what I've told you in this video, we don't hold over earnings. But there are going to be some good opportunities to short this stock over the course of the next 10 days. But we have to wait. Market pause Monday. Maybe we get a little bounce. They're going to try and recover some of this long red candle. We want to see half of this long red candle preserved, okay? We don't want to get too much above the open of this long red candle from Friday. We certainly don't want to fill in that overnight gap between Wednesday and Friday. We want this candle to stick. So Monday and Tuesday, little rally, trying to get through the midpoint, can't quite do it, struggling. LVS, during that market, little bounce effort in here, drip, lower. Yeah, that's what we want to see. That's relative weakness. That's a sign that institutions are selling that stock. Look at the price action on Friday. Steady as can be on heavy volume. Got to love it. Got to love that. So LVS, that's the pattern that I'm looking for. If we get this little bounce on Monday and Tuesday to try and recapture some of this. By the way, this long red candle and these long moves, you might get a day or two of pause, but you're not going to probably get 3 or 4 days. I think we crack that 100-day moving average later in the week. What do we got coming up this week? Well, I've told you the economic releases. We got retail sales coming out. That'll be important to see. First retail sales number since Christmas. So it's a substantial number. We want to know what the state of consumption is right now. Was it a good Christmas? Wasn't it a good Christmas? But what's even bigger is that we've got a number of banks coming out with earnings announcements. So let's go in, and this is something that we should do. Can you believe that earnings season is coming up already? It's kind of incredible. So we're going to go in and we're going to look at projected earnings, and we're going to go today through the next 5 days, so a week ahead. And let's focus on the largest companies. So those largest companies will have good option liquidity. These are the companies who are announcing this week. Okay? Banks. Earnings season is going to kick off with banks. JP Morgan, Citigroup, Bank of America. We want to see what they have to say. And if they start saying that we are seeing more bad loan write-downs, that is not going to be good for the market. So watch for that. Those stocks have held up extremely well. You start to see consumers getting behind, more credit card delinquencies, bigger bad loan write-downs. That is not good for the market, and that could be what cracks this little puppy down. So if we get a little bounce Monday and Tuesday in the market, I want to see the selling pressure continue on LVS. If it bounces a little bit because this is an oversold condition, then what do I want to see? I want to see that long red candle. I want to see half of it preserved. So very easy for us to gauge this. So that puts us somewhere, let's say at the 48.50 level, roughly. All right, 48.50. Market bounces a little bit. I kind of want to see 48.50 preserved. And if it is, it's still going to give me decent price movement down to the 200-day moving average. And if I'm correct and we get any kind of market selling, it's going to test that 200-day moving average. It could even crack it. Let me take a look at LVS without the FXI overlay, and we'll be able to see that it is currently in, so it's broken this horizontal support, and it's in that little gap right in there, which is likely to fill. And this was all based on China's, this wasn't built on LVS is really strong. They just reported a huge spike in revenues. This was all short covering based on China's stimulus program that was going to yield these big results and that the consumers are going to go out and start spending money again. Didn't happen. Okay, so these gaps are likely to fill. You take out that 200-day moving average and you're going to get a nice move lower. So you can short LVS. If you're buying options on it, make sure that those options span the earnings announcement. They are after the earnings announcement date. You are not going to hold the options that long. You are going to get out before the earnings announcement, but you don't want to buy weekly options that expire this Friday. Those options that expire after earnings are going to retain their volatility and they're going to retain their time premium. Buy in the money options, delta of 0.7 or higher, and go out into February, but make sure that you get out of those options. That's the price action that you're looking for. Market bouncy Monday and Tuesday. Stock trying to bounce a little bit, but can't get anything going. We don't want either one of them to really show any big progress. And then we start getting those bank earnings announcements, and I believe that's when we could see a bit of a crackdown below the 100-day moving average. And so when you get that move, and let's say that the market has had a couple of days, positive days in here, and we start to get back into this SPY long red candle, when you get that type of reaction that cracks this 100-day moving average, there's a very good chance that this move is going to produce follow through. Okay, we bounced off of it Friday, but the next move through it would probably be a result of those earnings announcements. And if they don't, if the market does not like what it sees on those bank balance sheets, and it does not like the forward guidance from those banks, that is meaningful. And a drop below the 100-day moving average will be meaningful, and institutions will start reducing risk. Yippee! That means that we get short, we add, we ride. Don't take quick profits. Ride that baby as long as you can, because it could be a nice long red candle that closes on its low. I will see you Wednesday for our live event. So please leave your comments and questions in the area below. Let me know how you like that thumbnail, okay? I hate doing all that kind of stuff, but Will and others have told me for a long time, if you don't put those types of thumbnails up on your videos, you're not going to get the clicks, you're not going to get the traffic. Pete, you're trying to reach as many traders as you can. Just do it and see what happens. So let me know how you like the thumbnail. Please make sure to visit us during the live event on Wednesday, and maybe some of this will still be unfolding. We will see you then. Thanks so much for watching.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.